This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 27 of Value Investing. Just like last episode, what I'm going to do is I'm going to go over some questions asked during 1994 Berkshire Hathaway annual meeting. I'm going to cover 3 topics today. The first topic is how you can identify a good management team. Second, you will be able to learn how to deal with other people's analysis and how it should influence your investment decision. And lastly, we're going to go over a history of Saloman because Warren Buffett made some investment in this company, and I thought that it would be interesting to go over whatever Warren Buffett has to say on this investment. So before we get started, let me just give you a quick disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. And also, 5-star review always goes a long way. Additionally, I wanted to give special thanks to Colby Eisenberg, who made a donation to this podcast through the link in the show note. I was excited to see the first donation. Thank you. Without further ado, why don't we get started? Okay, so the first question is about how Warren Buffett identifies good management team when it comes to making his investment decisions. I thought that this question was very important because, number one, Warren Buffett has only 3 criteria when it comes to making his investment decisions at a high level. First, he looks at whether the business has durable competitive advantage over the long term. And second, the business has to have the management in place who are honest and also competent. And third, the business has to be sold at a price that is reasonable compared to intrinsic value. So given only these 3 conditions, you might ask to yourself when it comes to making decisions, how you can identify the management team who are good and also honest and competent. And this is not easy question to answer. There's no magic formula that you can apply and just come up with some scores for different businesses. So there are a lot of qualitative factors that you need to consider. So I thought that this question was very important for us to listen directly from Warren Buffett. So let's hear what he has to say.
Well, I think you judge management by 2 yardsticks. One is how well they run the business, and I think you can learn a lot about that by reading about both what they've accomplished and what their competitors have accomplished, and seeing how they have allocated capital over time. You have to have some understanding of the hand they were dealt when they themselves got a chance to play the hand. But if you understand something about the business they're in, and you can't understand it in every business, but you can find industries or companies where you can't understand it, then you simply want to look at how well they have been doing in playing the hand essentially that's been dealt with them. And then the second thing you want to figure out is how well that they treat their owners. And I think you can get a handle on that oftentimes. A lot of times you can't. I mean, there are many companies that obviously fall in somewhere in that 20th to 80th percentile, and it's a little hard to pick out where they do fall. But I think you can usually figure out. It is not hard to figure out that, say, Bill Gates or Tom Murphy or Don Keogh or people like that are really outstanding managers. And it's hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum, too. It's interesting how often the ones that, in my view, are the poor managers also turn out to be the ones that really don't think that much about the shareholders, too. The two often go hand in hand. But I think reading of reports, reading of competitors' reports, I think you'll get a fix on that in some cases. You don't have to make 100 correct judgments in this business or 50 correct judgments. You only have to make a few. And that's all we try to do. And generally speaking, the conclusions I've come to about managers have really come about the same way you can make yours. I mean, they've come about by reading reports rather than any intimate personal knowledge or knowing them personally at all. So read the proxy statements, see what they think of, see how they treat themselves versus how they treat the shareholders, and look at what they have accomplished considering what the hand was that they were dealt when they took over, compared to what is going on in the industry. And I think you can figure it out sometimes. You don't have to figure it out very often.
Okay, so I think Warren Buffett brought up multiple points that are very interesting. So the first point is about how to identify good management team. He laid out 3 conditions. The first condition is you have to understand the management's past performance and compare that against competitors and see if their outperformance is just driven by industry trends or is driven by managerial expertise. So that's something that you can easily do by looking at financial report and also looking at competitors' financial reports. The second one is you have to look at how the management team allocated the capital across the board. For this matter, I highly recommend you go back to episode 17 where I talk about the company's capital allocation policy. So a company can basically allocate capital in many different ways. They can reinvest their capital back to business, or they can distribute capital back to the shareholders in the form of dividends or share buybacks. And there's no one correct answer when it comes to capital allocation policy. You have to look at the management team and see if they make the right decisions in terms of assessing which capital policy, allocation policy makes perfect sense at that point in time. And not all management teams are capable of making the right decision, because if you look at a lot of CEOs and people in the C-suite, they has gone up to that level not through understanding the finance, but they went up to that level through excellent operation for the most part. So they don't have great financial expertise in terms of allocating capital, and they usually assign this task to their CFOs. But I think this is one of the most important skill sets for the management team to have, and you can look at how they perform their capital allocation policy over the long period of time. So I'm not going to go into the details like which one option is better for which situation, because I already have covered through episode 17, but that's the second condition Warren Buffett mentioned. The last condition Warren Buffett mentioned is that you have to look at how the management team treats their owners. So shareholders sometimes are blinded by how things are operating within the company. So management has all the insights, all the details, and they have so much power to make various decisions. They can only serve themselves at the expense of shareholders. So you have to look at different documents. So for example, Warren Buffett mentioned about proxy statements and see how they treat themselves versus shareholders. And also you can read various reports, including annual reports and so on and so forth. The last thing that I want to mention is that he emphasized that there's no need for you to know every single business in the stock market. As long as you can pick a few businesses that you understand in terms of business model, in terms of management team, I think that's all you need to know. You don't have to understand every single stock, every single management team. As long as you can pick someone like Bill Gates or Jeff Bezos, I think that's good enough for your investment portfolio. Okay, so let's move on to the next question. So the next question is about an article from Barron's, trying to assess an intrinsic value of Berkshire Hathaway and what is the views from Warren Buffett.
Yeah, there was an article about a week or so ago in Barron's. The same fellow wrote an article about 4 years ago reaching pretty much the same conclusion, and I hope he hasn't been short in between, but I would say this, it is not the way I would calculate the intrinsic value of Berkshire, but everyone in securities markets makes choices on that. Every day somebody sells a few shares of Berkshire and someone buys, and they are probably coming to differing opinions about valuation. I would say that I found it strange that apparently he forgot we were in the insurance business, but that's not so. It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane.
Okay, so I thought that question itself was not that great, but the answer to that question by Warren Buffett was something that you really have to consider. So Warren Buffett basically said that you have to do your own homework. You can leverage other people's analysis, but if you get influenced in some ways by other people's analysis, and by the way, you'll find a lot of articles related to whatever companies that you're trying to invest. And some articles will talk about positive things, and some other articles will talk about negative things. But whichever company you're trying to invest, if you don't do your own homework, and if you rely on other people's work, and if you get influenced by the articles out there, then you're not going to be able to stay in the course. Because whichever stock you own, whether it's a great company or not so great company, you'll see a bunch of articles coming out every single day talking about that company. Especially if it's a large company, then you'll see more articles. So if you're the type of person who get influenced by other people's work, what other people say, you're not going to be able to stay in the course of the long term, and you're not going to be able to see your stock going up by 10 times or 20 times. So you rarely see these stocks, but once you have them, you have to have them in your portfolio for a long period of time. I'm not saying that long-term investment is always good, because some companies such as GE has experienced significant drop in stock price over the last 5 years. But what I'm trying to say is that if you did your homework and if you did it in the right way, then you should be able to stay in the course for a long period of time without getting swayed by all these different analyses. Okay, let's just move on to the next question. Next question is very fascinating in many aspects. First, the question was asked by Bill Ackman. Bill Ackman is a hedge fund manager, and his hedge fund is called Pershing Square Capital Management. And he has been in the public eye for many years, so he's quite well-known hedge fund manager along with Carl Icahn. I just thought that it was fascinating because the annual meeting took place in 1994, and that was 10 years before he founded his hedge fund, Pershing Square Capital Management. And he went to Berkshire Hathaway annual meeting and asked this question. Let's just hear directly from him.
Mr. Buffett, my name is Bill Ackman. I'm from New York City. And my question relates to the appeal of Saloman Brothers as an investment. You talked earlier about leverage and the dangers of leverage. Salomon is a business which is levered 30 to 1, which has very narrow margins and earns a relatively modest return on equity in light of the amount of leverage that they use. What is the appeal of the business to you?
We have here today the chief executive of Salomon Inc., the parent company, and also the chief executive of Saloman Brothers, the investment banking arm. And I would say one of the things Charlie and I feel extraordinarily good about are the two fellows that are running that operation. They did an exceptional job under extraordinarily difficult circumstances, as did John McFarlane, who's also here today. The three of them, I mentioned four people in the annual report, and Salomon wouldn't be here today without those three, and it wouldn't be the company in the future that it's going to be without them. And they did an absolutely fabulous job. It's the sort of business that, as you point out, uses a lot of leverage. It doesn't, in one way, it doesn't use as much as it looks like, and another way, it uses even more than it looks like. But the test will be, A, whether they control that business in a way that leverage does not prove dangerous, and secondly, what kind of returns on equity they earn while using it. You certainly should expect to earn somewhat higher returns on equity when you are necessarily exposed to a small amount of systemic risk and significant amounts of borrowed money than you would in a business that's an extremely plain vanilla business. But I don't know whether you've met Bob and Derek, but I think you'd feel better about having leverage in their hands than about any other hands you can imagine. I've mentioned this before, but it's worth mentioning again. Derek took on the job of being the operating head of Saloman Brothers on August 18th, 1991. He couldn't know what he was getting into exactly. 2 months later or 3 months later, we never had a conversation about compensation. He did not ask me for Berkshire or my guarantee for indemnification because he was walking into unknown legal problems we didn't know what we would finally uncover. And he worked incredible hours to keep that place together, which was not easy. Bob Denham, I called, I guess on the 23rd or so, I called him on a Friday. I got home on a Saturday, the 24th of August. He was living a nice, pleasant, peaceful life in California, and had a first-class law firm, good group of clients. Wife had a good job there, and I told him I was in a mess and there wasn't any second choice. And 3 days later, he was back in New York and living in a small apartment in Battery City and handling the general counsel's job at Salomon. They found John McFarlane on that Sunday on the 18th. I think he was running in a triathlon or something. Not a practice that Charlie and I follow, but and he was yanked from that and came down. And I think John lives over in New Jersey, but he holed up in the downtown athletic club, and it was his job to keep funding what was then a $150 billion balance sheet during a period when people right and left were canceling us, not because we weren't a good credit, but because they just didn't want to have anything to do with us for a while. And the World Bank and the State of Texas Pension Fund and CalPERS, all these people were shutting off funding at a time, and funding in a business, as the gentleman just indicated, is the lifeblood of an enterprise like Salomon. And so those three deserve an enormous hand by the Salomon shareholders, but by this group in turn, because we have an important investment in.
Okay, so there are a couple of things that I want to point out here. First, as I mentioned, I was surprised to hear Bill Ackman asking questions during Berkshire Hathaway meeting. And second, Warren Buffett mentioned multiple times that how important it is to have the right management team for his investment. And in this case, he was talking about his Salomon investment in 1987 when he invested $700 million in Saloman Brothers. Third, I want to just go over the history of Salomon very quickly just to give you a flavor of how things could go wrong even for Warren Buffett. Because as I mentioned, during 1987 market crisis, Warren Buffett invested $700 million in Saloman Brothers. And this seemed like a classic Buffett play because he invested in what appeared to be a solid company during a market turmoil. Be fearful when other people are greedy. Be greedy when other people are fearful. So it was a classic Buffett investment play. However, things didn't really turn out well for Warren Buffett. A bunch of scandals followed after the initial investment, and Warren Buffett at some point was forced to become the interim chairman of the company. And he had to clean up a lot of mess, and he had to bring the company back from the bankruptcy. And also he had to testify before Congress, so he had to go through a lot of things that he wouldn't normally do under normal circumstances. Finally, in 1997, travelers agreed to buy Saloman Brothers for $9 billion. So by then, Warren Buffett was able to make profit on his initial investment, $700 million, because his stake by then was $1.7 billion. So Warren Buffett was able to make more than 100% profit from this investment. But if you ask Warren Buffett, I think the initial investment probably was not a good one for him because he had to spend tons of time in order to clean up the mess in the company, and probably was a huge relief for Warren Buffett to sell this one to another company. By the way, the Saloman Brothers is now part of Citigroup, but they changed the name because of a lot of scandals that have happened in the past. Okay, that's it for today's show. We talked about three things. First, we talked about how you can identify good management team from various investment opportunities. Second, we learned how you can deal with other people's analysis. The simple message here is to do your own homework and don't get influenced by other people's analysis. Lastly, we went over the history of Saloman Brothers just to see how even Warren Buffett can make a mistake but still come out strong with some profit. Thank you very much and see you next time.